This is part 1 of chapter 10. Welcome. We're going to be looking at cost recovery in this segment, and we're just introducing the topic here. We'll get into more detail in other segments. Cost recovery is this idea that we've got an asset which has a longer life than the current period. And so we want to capitalize the cost of the asset and then recover its cost over the relevant period. Now, for tax purposes, the relevant period is sometimes not the same as it would be for financial accounting. And in fact, often it's not the same. And sometimes the relevant period is not necessarily the useful life of the asset. So we're going to get into these details. But the point about cost recovery is we are recovering cost over time. We can use one of these three methods: depreciation, amortization, or depletion. Our focus is going to be on depreciation to start with, but we'll look at depletion and amortization a little bit later. Now, as I said, cost recovery is really just allocating cost over a period of time and then claiming deductions accordingly. Now, in order to use cost recovery, the asset has to be used in a trade or business. In other words, I could not depreciate an asset that I was just using for personal purposes. I drive back and forth from work. I could not depreciate my car. Okay, so it has to be used in a trade or business, or alternatively, it has to be used for the production of income. So if I'm a real estate agent and I'm using my car to drive people around and show them property, that would be used in my trade or business. Real estate agents are considered independent contractors. So in the trade or business of my real estate business. Alternatively, I might have rental property, and I might use my car to drive back and forth to maintain my rental property. That would be used in an income producing activity, and I could deduct depreciation on my car for the mileage that I'm putting on to get back and forth to look at my rental property. Okay, so again, trade or business or income producing, but I would not be entitled to a deduction if it was used for personal purposes. We mentioned land before. Land has an indefinite life, and so I would never recover its cost through depreciation or cost recovery. Sometimes I have an asset that's used for both personal and business. Take my real estate agent. The real estate agent is probably using their car for personal purposes, maybe 25% of the time. They go shopping and other things with that car. They might be using the car 75% of the time for business. In that instance, we're going to prorate their deduction. So in other words, we're going to treat 75% of the car as business, and we would be allowing depreciation on that 75%. The personal portion, we would not be allowing depreciation on. We'll look at that in a little bit later. Sometimes you're converting an asset from personal to business. For instance, I might have a car right now that I drive back and forth to work, and I decide I want to become a real estate agent. So I'm now going to convert that car and transfer it from something that was used entirely for personal to something that's now 100% used for business. A real estate agent might not use their car 100% for business, but if I were to start a business and use it 100%, then that would be a nice, cleaner example. In that case, the question is, well, what is my basis for cost recovery? I know maybe that I bought the car for $35,000. But at the time, after I've driven it for several years, it might have gone down in value. It might only be worth now $20,000. So for purposes of cost recovery, I look at that lesser of fair market value at the date of the conversion, or my adjusted basis, which is what I paid for it. What I paid for it is my basis. And I'm going to claim the depreciation on the lesser of those two. So for the case of my car, it's going to be the $20,000. It's the lesser of the fair market value or adjusted basis at the time of conversion. Now, depreciation prior to 1981 used the traditional methods that you're familiar with, the straight line, double declining some of the years, or any other method. These were all allowable. That's not the case anymore. After 1980, in other words, 1981 thereafter, there have been a series of changes with respect to tax depreciation. These were under President Reagan, and so the most significant one actually occurred in 1981 when we changed from using the traditional methods that we use for financial to using an accelerated cost recovery system, ACRS as it was referred to. This was a major change if you had a mindset back in that day to think that we weren't going to use a financial accounting system. We were going to accelerate it beyond what financial accounting actually allowed. It was actually too good to be true. And so in '86, they modified it and said, we're going to slow it down just a little bit. It's still relatively fast, and you'll see with tax reform, we've put it on steroids again. It's a very fast recovery. But this is temporary, and eventually we'll go back to the regular rules for makers. So before we get into the maker's rules and how they actually affect, let's first of all look at something else that's also occurred relatively recently, and that's the repair regulations that have been issued by the Treasury. The nickname is the repair regulations. That's not the technical name, but everyone will know what you're talking about if you say the repair regs. The repair regs have an important component which is referred to as a de minimis safe harbor. It's important because it allows companies to essentially write off the cost of certain assets which would have a longer life and would, under the maker's rules, require capitalization and hence depreciation. But because the de minimis safe harbor rules exist, we can actually go ahead and just expense them right away. Now, the idea is that this is low-cost, personal-type property. Now, it's not personal use. Personal would be like a car or a delivery truck or things like that. But it's still being used in a trade or business, right? We still have a business requirement. And under these de minimis safe harbor rules, up to $5,000 can be written off on a single asset per invoice or item if we have an audited financial statement. So if you go to work for a large company that has an audited financial statement, up to $5,000 per item can be just written off. You wouldn't have to capitalize it and then start the depreciation process. On the other hand, if you do not have an audited financial statement, you're a smaller size company, up to $2,005 is the max that could be written off per item, per invoice. Okay, so a smaller amount, but still a pretty healthy amount in terms of simplifying a lot of the capitalization and depreciation that was taking place before. Now, there's a slight downside to this, and that's with respect to the qualified business income deduction that we referred to earlier in Chapter 6. In Chapter 6, we mentioned that there were wage and property limits. And so for the wage and property limit, you actually want to start capitalizing things to increase your property. Remember, there's that 2.5% that you're allowed to add to 50% of your wages and trying to give you a larger deduction. So just FYI, even though the de minimis safe harbor exists and you could go ahead and write this stuff off right away, it may not necessarily be to the taxpayer's benefit. Again, this is the sort of thing where tax gets really interesting because you're trying to trade off different rules to find out what's the best situation for a particular taxpayer. This note down here simply states that if we have an invoice that totals more than $5,000 or $2,005, we could still write things off if the invoice actually itemizes. So let's say we buy 10 things and the invoice says that we bought 10 of these and each of them was valued at maybe $3,000 and we have an audited financial statement. We could go ahead and we can write each of them off, okay? Because the invoice tells us we've got, even though the invoice is for $30,000, we know that each of them was at $3,000 each, and that was less than $5,000, so we're good. Okay, now there's also a component of the repair regs that deals with routine maintenance. Now, some maintenance gets quite costly, and so the typical way that tax law was treating this was you had to go ahead and capitalize that maintenance cost. That was creating actually quite a bit of confusion because for financial purposes, you were not capitalizing that maintenance cost. And so now we have some rules that are, I think, more in sync with financial accounting. Essentially, you can go ahead now and deduct the cost of routine, preventative, or cyclical maintenance immediately. Makes sense. If I'm going to be repairing something all the time, then I should be just allowed to write it off. It doesn't have really a long-lived life, irrespective of how much it costs me to repair it. Now, there are two conditions with respect to replacement. So if I've got parts that are damaged or worn, there are two requirements in order for me to get an immediate deduction. And the first one deals with how frequently I'm going to have to make this repair or replacement. So if I have to replace the part more than once during a 10-year period for a building, let's assume I have an elevator that seems to wear out every 9 years. Elevators are considered structural components of a building. But elevators take a lot of abuse, particularly in certain types of buildings. And so if I had a normal replacement of 9 years on this, I could go ahead and I could say, well, since I'm making this replacement every 9 years, I should be allowed to just go ahead and deduct the cost. Okay, I would satisfy that condition. An elevator, again, being a structural component of a building. Alternatively, if I have something that's not part of a building and I have to replace that more than once during its class life, let's look at laptops. We're going to discover that laptops have a maker's class life of 5 years, but many businesses replace laptops every 3 years. Some even more frequent than that. So we could argue here that we should be allowed to expense the cost of the laptop under this particular rule. We replace them they're damaged, they're worn, we replace them every 3 years, and that's shorter than their maker's class life. Okay, so that's the first issue. The next is simply that the replacement must not be part of a major renovation. Hotels, retail often does major renovations. They tear up all the flooring, they repaint, they do it all, tile, everything. So if that's the case, we expect that to be capitalized. Okay, so even though we might do it with some frequency, if you go to most hotels, they do seem to renovate quite frequently, it would be a major renovation, millions of dollars, as opposed to just we're replacing the elevators in the building. Now let's move into makers, which is going to be the focus of much of our discussion. Makers has class lives. You can see them right here. So you're going to look to a publication from the IRS, and it will tell you what the class life is for different types of property. We've kind of summarized them over here with some examples. And in our class here, we're going to stay with the basics. We're not going to get into some sort of exotic sort of equipment. So we're going to focus primarily on the 5 and the 7-year class. And you're going to notice you're allowed to use double declining balance for those classes. In fact, you're allowed to use double declining for many classes of assets. You use 150 when you get into the longer life, which is like landscaping and land improvements and things of that nature. And then for real property, because all of this stuff would be considered personalty. But for real property, we use the straight line method, and you'll notice the lives are much, much longer. There's a distinction here between residential. This is where people live, your residence, and non-residential. This might be like retail, office buildings, things of that nature. Okay, so the distinction, first of all, between personalty and realty. Realty was real property, buildings, things of that nature. And personalty was generally something you can move around, cars, things of that nature. We have a slide coming up with just some examples. Keep in mind the class lives are different. And you can only depreciate if it's for use in a trade or business or income producing. If it's for personal, no depreciation would ever be allowed. Here's some examples. Personally, a truck, a delivery truck. If it was income producing, it might be some rental equipment that we rent out, something for farming and other sorts of things. Personal might be a car. No depreciation on if it's personal use. Realty, buildings. So we're looking at office buildings for trade or business, rental for income producing. Your home, no depreciation on your home. Now, makers, the modified accelerated cost system that was introduced under President Reagan, so it's been around a long time, is actually in theory a very, very simple way of calculating depreciation. You look at the basis, which generally is what we paid for plus whatever it costs to get it up in service and things of that nature. So the amount that the cost hasn't been recovered. So you can kind of see it down here. But when we buy in it, it's pretty much the cost and whatever necessary to get it up in service. And then we multiply it by the percentage that we get off of a table. And if you look at the chapter, you've noticed several of these tables. We'll be presenting some in these lecture notes as well. And that gets you the depreciation. That's pretty simple. Take the cost, multiply it by whatever the table tells you, and that gives you the deduction. You don't have to be a genius to figure that out. But you do have to be a genius to kind of navigate your way around finding the right table and making sure you're getting everything right. Okay, so we have some conventions. Because of tax reform, the conventions have been somewhat streamlined, so that helps substantially. But with respect to personal property, again, this is not personal use property. I'm talking about cars and stuff here. Delivery trucks, computers, office equipment. It's just personalty. I'm allowed depreciation, and my convention is the half-year convention, which means if I buy something during the year, doesn't really matter when I buy it, I get 1/2 that year's depreciation. And the year I sell it, I get 1/2 that year's depreciation. So in other words, if I have a class life of 5 years for makers, I'm actually going to take 6 tax years to depreciate it, because I'm only going to get 1/2 in the first year and 1/2 in the last year. And I'm going to have 4 full years in between. 5 full years, excuse me. So my total would be 6 tax years to depreciate a 5-year class life. Now, if I'm dealing with buildings, real property, I'm not going to get the same speedy write-off that I would for personalty. And so I'm now going to be using a different convention. It's not the half-year convention, it's the mid-month convention. So if I buy something in the month of April, say I buy it on the 1st of April, I'm going to get 1/2 the month of April. Even though I bought it on the 1st, I think I should be entitled to the entire month. The mid-month convention says I get half of that month's depreciation. If I were to buy it on April 30th, I'd still get 1/2. So you can see taxpayers have an incentive to kind of time things towards the end of the month if it's a significant cost that we're talking about. So you get half of the month. In my case, April, I just get half of April. And then I get full depreciation for every month after. All right, let's just go through some examples here. We've got F who buys $10,000 of copying equipment with the maker's class life of 5 years. He buys it on January 10th, the middle of the year. That's nice, convenient. And then on May 4th of the 3rd year, he basically sells it. Okay, the first thing is to find the right table. Now we're using the half-year convention because this is personal T, and it's a 5-year class life. So we can see the table is right here. In this instance, we're told that he sold it in that 3rd year. Now, this is a double declining balance table, and you can actually check the validity of the calculations. You know that a 5-year life using straight line is 20%. You know that double declining allows you to multiply that. So you'd actually be entitled to a 40% deduction the first year. But you also know that we're using the 1/2 convention, half-year convention. As a result, the first year you should have depreciation of 20%, and that's what you see in the table. Okay? And then after that, if you do double declining, you calculate it all through, you find that 32 is a full year for the next year, and then 19.2 is full. You'll also notice that the table is going to change to straight line when it's more advantageous. You can see that occurring if you look at this table. And then you'll notice in the last year, there's always a half. So you get a half year's depreciation in that last year on the table. So the table has automatically taken into account the half-year convention. That's why it's called a half-year convention table in the first year and the last year. In our example, however, the taxpayer didn't sell the equipment in the last year. He didn't hold it until that 6th year. He sold it in year 3. The table is claiming a full year depreciation in year 3. So we're going to have to make an adjustment. That 19.2 isn't quite right. We're going to actually have to allow only half of that because he sold it in that year. Okay, so you can see that that 1/2 adjustment is made in year 3. We don't have to adjust year 1 because this is already calculated with the half-year convention. But year 3 is not. We have to actually wait until year 6 to get that half year built into the table. And we've sold it before then. So the depreciation deductions we just calculate out using the table, but recognizing if we sell early, we have to make a manual adjustment. It's an easy enough adjustment for a half year, but we do have to remember to make it. And here we see it. All right, this is a problem out of your textbook. So we have a company that acquired and placed in service the following assets. They're not going to elect anything special. We'll talk about Section 179 and bonus depreciation later. But for now, let's just focus on the basic rules. We've got a cost here on some equipment. We can see that. We can also look at these dates. Dates might be relevant in some instances. We notice that we've got 2 pieces of personalty, the equipment and the furniture. The equipment's going to be a 5-year life, and the furniture is going to be a 7-year life. The building is commercial, and so that's going to be a 39-year life. Excuse me. And so now it looks like we're ready to go. Well, we look at these months, okay, and so we know this one we're going to use a mid-month because it's realty. Mid-month, so we'll get half of the month of November and then full for December. These others we're going to use the half-year convention. Okay, so we have to find the right table. With respect to the equipment, we said that that was a 5-year asset, so the first year would be 20%. The equipment we said was 7 years, so we can see that that is 14.29% the first year. And the building, we have to use a special table for, which is in your textbook. If you hunt around, you can find it. And in this instance, we know that we bought it in the month of November. The table in the first month always calculates it as a half month, mid-month convention. So we don't have to make any adjustments when we're buying something. It's only when we sell it. Okay, so we're good on that as well. We calculate out the total deduction. And you can see where I'm pulling all these numbers from. This is again kind of illustrating. This first year is already taken into account the mid-month or half a month. And then after that, it's a full month until that very final 40. Remember, a 30-year life for makers is actually going to take 40 years to recover for tax purposes. We always have to add an extra year because we're using half in the first year. Half month, half year, whatever. We wouldn't get a full year, and so we have a longer period for tax purposes. All right, we continue on, and now we're told that they sell these assets in the third year on January. With respect to the equipment and the furniture, the adjustment is relatively straightforward. It's a half-year convention that we're using, and as a result, we just have to find the percentage for the third year for the two assets, and then just take a half. We're good. Now, with respect to the building, the table is giving us a full depreciation. Doesn't matter what month, you can see that's all the same because it's assuming it's a full year's depreciation that's allowed. So we now have to think about taking a half adjustment, and it's based on how much we've actually been entitled to. If we're selling on January, we're deemed to have held it for half of the month of January. Okay, there are 12 months in the year, and if we only hold it for half of the first month, we're only going to be entitled to a relatively small amount of that deduction. If we'd held it until February and sold it sometime in February, we would then have had it for a full month in January, and we would have had it for a half month in February. And so our deduction would have been 1.5 over 12, or our adjustment factor, 1.5 over 12. But in this instance, we're in January, and January is only going to give us half of the month of January. So we make an adjustment there to get our depreciation calculation. You can kind of see how these are working out here. And then you see the table, which we do need to adjust. All right, that gets us through the basics. I'll see you in part 2, which will look in more detail. Thanks for listening.